This is the current federal tax developments for the week of April the 7th, 2025. Current federal tax developments are brought to you by your state society of CPAs. This week, we're going to be looking at a few things happening in the area of tax. First, we're going to look at essentially three cases is really what we're looking at this week. First, we're going to look at the case of Ranch Springs LLC versus Commissioner, which is a recent case on valuation of conservation easements. Pitfalls of aggressive tax planning. If something looks too good to be true, there's a decent chance it is for taxes. And a taxpayer has a duty to actually consider that when they do it. They can't just blindly go along with whatever shows up in front of them. Secondly, we're going to talk about a case where taxpayers got out of $1 million assessment under an innocent spouse claim, but it came back to haunt her later when they ended up. She tried to claim rights to an asset the IRS was seizing and was selling off. She tried to claim rights to 50% of that from her ex-husband. And the court essentially said, look, you told the IRS you had no rights and assets. That's how you got your innocent spouse relief. You can't come back now and say suddenly, hey, I've got half of this. Sorry. End of the day. So we'll talk about that duty of consistency issue. And it's important to note that it doesn't really matter whether she's right that she had 50% interest in that. We're going to talk about why the duty of consistency renders that irrelevant. And finally, we're going to talk about the murky waters of the investment tax credits and passive activity rules. We'll look into a case, Strieby versus Commissioner. And this is also one of those cases where there is this wonderful too good to be true type of tax shelter. And again, it doesn't turn out well for the taxpayer. So let's start with the Ranch Spring case, which is interesting because it's a published decision. And apparently it appears the reason it got published was because the tax court specifically addressed the use of an income stream basis of valuation in a case like this, basically saying that, yeah, we're not buying it, is what they're saying. So that was kind of the key as to why this one got published, it appears. But this is a case in evaluation of a conservation easements and the pitfalls of aggressive tax planning, including the fact that there are some penalties for which reasonable cause is not offered as an option to get out of the penalty. And as you'll discover, when you have an overvalued conservation easement and it triggers beyond a certain level, yeah, reasonable cause doesn't come into play. That isn't an option anymore. Let's talk about this case. This case deals with syndicated conservation easements, SCEs. The tax court has been very, very interested in the IRS in evaluating what appear to be overly aggressive valuation methodologies for a conservation easement. What happens in many of these cases, in the aggressive cases, is, you can give, and it's a perfectly legitimate gifting option. It's a perfectly legitimate deduction. You can gift a qualified conservation easement in a piece of property you own to a charity in perpetuity. And, so that property, even if you sell the property later, it moves to another buyer, it's going to be stuck with this basically easement that certain things can't be changed. And normally it's to preserve the look or preserve the nature of the area, etc. So there's various things you're going to be shut off from doing. And you get a deduction. And generally, how these are valued is that you look at what would the property have sold for, in theory, in a fair market sale, if there was no restriction involved. So there are no restrictions on it. What's its value that way versus what would you be able to get from a willing buyer with that restriction in place? And the difference is treated as the conservation easement or the deduction. The problem comes that when these are packaged, it ends up that usually they go out and they obtain a piece of property of some sort, buy it on the market, get it from wherever, and then hold it for just over a year. You're in the partnership for just over a year, and then a year later, they give away the conservation easement. Okay, so far so good. And again, they do that because to be a contribution of property, we need to be a capital gain if we had sold it. So basically, we have to hold it for a year. But just past a year, they do it. And amazingly, the value of the property has gone up astronomically over that 1 year period. And of course, so the conservation easement is now a deductions claim that is many times the original cost of the asset that was paid. And that's a problem. Now, as you may be aware, when we talk about this in partnership taxation, generally you don't have a basis problem in that case because you only reduce your basis in the partnership interest. So normally you can't claim a loss from a partnership in excess of your basis. But for this type of appreciated asset contribution, you're able to claim the full deduction, even though you don't have anywhere near that level of basis. You just can't claim a deduction. Essentially, it looks to the base of the property given as opposed to the fair value. So if this magic worked, if this was the reality of the situation, then yes, you would amazingly have, let's say, put in $100,000 and a year later end up with a $1 million deduction. Except that doesn't seem plausible. And it seems much more plausible if there's a piece of land that you know you could buy today for $100,000 that would sell on the open market for over $1 million in just over a year, and somehow you were able to buy it at $100,000, you would probably just sell the land in over a year. That's where the plausibility of these come apart. So let's talk about this particular situation. In this situation, Ranch Springs acquired 110 acres in Alabama in December of 2016 for $715,000 or $6,500 an acre. It was zoned A1 agricultural. Of key importance here is that means it had to be used for agricultural purposes and could not be used for mining. And we'll talk about why that's important here in a second, because that's the theory of how they're going to get it worth so much more. Now, in December of 2017, just a year over when they had acquired it, they made a conservation easement donation and they claimed a charitable deduction of $25,814,000. Now, that's quite interesting because we still have the land, and we only paid $750,000 for the land and all rights just over a year earlier, right? So how'd that happen? Well, their appraisal asserted the highest and best use, HBU, was limestone mining for that property. And they valued the land, if used for limestone mining, at $236,673 per acre using a discounted cash flow method. A way to reduce the cash flow, to basically take the cash flow we'd get from running the mine, reduce that cash flow, net cash flow, and say that's the value of the land. As you might guess, the IRS was a little bit skeptical here of this operation and how in the world it managed to generate that large of a conservation. How in the world did that happen? If that really was the best use, if it was this huge bargain for, using it for essentially limestone mining, why in the world didn't somebody just buy it for limestone mining at that super cheap price? That'd probably be a good question. Now, valuation principles you run into in these cases are essentially, first, fair market value. Generally, a charitable contribution is the fair market value at the time of the gift, and the fair market value is the price between a willing buyer and seller, each of whom has full knowledge of the situation, and neither one of which is under compulsion to buy or sell. That's considered a fair market value. Okay. The highest and best use would be the most profitable, legally permissible, physically possible, and financially feasible. All of those are important. Use that is reasonably probable in the near future. That final point is also very important. Can it be used for that purpose in the near future? Now, if you have a proposed highest and best use that's different from its current use, remember, right now it's being used for agriculture, right? It requires demonstrating a closeness in time and reasonable probability of that highest and best use taking place. And zoning restrictions are a key consideration. Remember, this property was only zoned to be used for agricultural use. That was important. Not limestone mining is not agricultural use, right? Bottom line, we have a problem there. And the way you value the easement, as I already mentioned, is typically used before and after approach. So you look at how much was the property worth before this restriction was put on the use of the property by the buyer, and how much is it worth after? How much would a buyer now pay knowing they can't do that, right? What they can't do. That's the conservation easement's value. As I said, the real fight here is going to be over the highest and best use, and the valuation methodology used. So we have both of those problems in today's case. Now, the tax court looked at the facts, and one of the big things that happened was they rejected the limestone mining as the highest and best used. The taxpayer failed to establish a reasonable probability that they would obtain rezoning from agricultural to mining use. Remember, you couldn't put a mine on that property unless you got the property rezoned. So therefore, in order to have this be a reasonable use, a use you would consider in the near future, you had to show that it would be, the zoning would be taken care of. There'd be no problem, right? They never actually filed a rezoning application. That would have obviously been the best option. Get the property rezoned. You would prove it could be done, right, for that use, right? The evidence they presented, which was some letters from some local officials, essentially was unpersuasive because it's highly likely the neighbors are not going to be thrilled with a limestone mine next to them. And they would almost certainly show up in loud protest. I mean, it's fairly easy for somebody, a mayor or someone to say, yeah, no problem. We expect this to be fine, that you could get it done. And that was the kind of letters they had. But in the real world, you can't really get things rezoned so nicely if it's totally out of line with what the area is being used for now. Neighbors will loudly complain. I mean, I remember here in Phoenix, we had an election one time that was voting on whether they could rezone a parcel in the city of Phoenix, one single parcel, to put a gas station on. So yeah, these zoning fights are usually not easy, and limestone mine probably is more objectionable than a gas station. So bottom line, yeah, we're gonna have fights over that because, by the way, the gas station, the voters, we had in essence a petition that got it forced to go to the ballot to make the call because the city was going to approve that change and the neighbors didn't like it. The court also rejected the income approach, discounted cash flow. The court found it was wholly illogical and erroneous as a matter of law. And that's what's key. It's a published tax court case, so this essentially sets the standard going forward to use this discounted cash flow approach. Now, let's be careful here. This is the tax court only. Obviously, the taxpayer can appeal this decision, and it is possible a court of appeal would overrule the tax court. But until that happens, the tax court has put everybody on notice that effectively, don't bring the discounted cash flow method in for this type of raw land valuation, right? No rational buyer, the court held, would pay the entire future value of a business for one asset. Yeah, you can't, it's not just like I put my money down, I've got that, then I go get the limestone. It's like I need a lot of equipment and other things to mine limestone. I need lots of other things in play. Even if the value of the limestone mining operation was, that huge number, it doesn't really matter. I need more than just the land to do it. There's not a limestone mining operation on the property at this point. Therefore, strictly using only the discounted cash flow is probably not going to work. And they said the owner-operator version of equating land value to net NPV, the net present value of the cash flow of a hypothetical business, is fundamentally flawed. So bottom line, they're saying don't come to us with this one again. If you have that one, then you're probably looking at either knowing you've got to go to the Court of Appeals, you're going to lose at the first tax court level, or you got to pay the tax on the assessment, then come back and go into district court and hope you do better there or in the Court of Claims. But yeah, tax court, not going to get anywhere with this time. That's what it goes. Now, they said the before value determination, which is key, the comparable sales method is rendered by the tax court as the most reliable. They said, therefore, the strong evidence is given, strong value is given to the evidence. That is the 2016's arm's length purchase price of $6,500 per acre. That has almost a presumption of being the correct value, right? And the IRS's expert came up with a similar value a year later. That's the best evidence. The best evidence of fair value is an actual buyer who buys the property. Right? Actual buyer buys the property. That proves, of course, at that point, you don't care anymore because you sold the property. But actual buyer is what you're looking for here, or certainly a comparable sale. So if there was another, if there was another piece of farmland right next door that was similarly, limestone heavy, and it sold, what did it sell for? And here's the problem: if you had another plot next door, then this purchase of this plot would have essentially been a key piece of evidence. You've got to explain, give me a plausible reason why somebody paid $6,500 per acre a year ago, but today that same reasonable buyer would pay this much, much larger number. Okay. The easement value was determined under that methodology to be $335,500 based on the preferred before value of $720,500 minus the stipulated after value of $385,000. The two parties had stipulated what it was worth afterwards, right? In essence, what a buyer would pay now for it. So that part wasn't really determined. It was just, everybody agreed to use that number. There was, and this is important, a gross valuation misstatement penalty. The claim value, $25,814,000, exceeded the correct value, $335,500, by essentially 7,694%. Not exactly a minor, shall we say, difference, right? And, under the IRC, the 40% penalty was applied. We were way overvalued. And the big takeaway is when you have a gross valuation misstatement, there is no reasonable cause defense, right? Many penalties say that, if the taxpayer had reasonable cause, they relied in good faith on an expert, etc., then they could get out of this. They could say that if they relied upon their tax advisor who did a full study of this, etc., that they then, could say, okay, they're not experts in valuation, they're not experts in tax law, but they had an independent party look at this. Now, probably they didn't have an independent party look at this, but that doesn't matter, right? So it doesn't matter. We don't have to show it was unreasonable to rely upon the valuation because there is no reasonable cause. If the actual valuation is off by this much, the 40% penalty is automatic and there's no way out. Okay? That makes that somewhat important. Now, key takeaways from this case: on conservation easement, marketed ones like this, actual transactions are key. That initial purchase is a problem. Recent arm's length sales. You need to have a very, very, very good, excellent explanation, preferably with sales nearby now at this huge new value, to explain why it was reasonable to pay $6,500 an acre, or more importantly, why it was reasonable for the seller to sell $6,500 an acre a year ago. But today, that same seller could get this, $270,000 per acre amount. Why? How does that make any sense? And, you've got to be able to explain that. And like I say, an actual sale that actually proves that number is pretty much what you're looking for. Because if every other sale that they can find is at the $600 an acre level around the area, it's going to be tough to carry your theory. You're going to put it that way. You got to have a realistic highest and best use analysis. Your highest and best use must be legally permissible, physically possible, financially feasible, and reasonably probable. Unsupported assumptions are not going to suffice. That was one of the complaints in this, about the IRS, and the court accepted. Yeah, the assumption of rezoning was huge here, and they found it implausible, right? It's just not realistic that would happen. If it was that easy to do, somebody would have done it. Right? Somebody, in essence, there's all this money sitting there, cheap land, and then you get it rezoned, and they'd have done it. That's your big problem. They do say that they really, the comparable sales approach is the most reliable for undeveloped property. So you need to find a comparable sale in line with that valuation at the back end. Because the problem is with the way these are structured, like this one was, you've got a comparable sale a year previous. And that on the same property, it's like the perfect comparable. So you need to have something else to show why that no longer holds. The income approach, obviously, the tax court is putting you on notice. They consider this utterly inappropriate for raw land. So you really need to do that. Of a hypothetical business, it's not, you can't equate the two, because it has no income history. We have that. That's just not going to work. Remember the huge consequences of overvaluation, especially if a client's asking you about this deal and they got this nice flashy brochure and they got this, whatever other documents. Remember the gross valuation misstatement. The client has to understand that if the court finds the valuation is wrong, and this is where I, as a CPA, would probably say right away, I am not a valuation person. I don't do valuations. I cannot evaluate this evaluation for you. I mean, I could probably recognize a lot of garbage, but, I'm not going to evaluate that. So, you're going to be trusting this guy. And if this guy's not right, if the court rejects him, you're going to be hit with a 40% penalty. And that's, that's not small. So understand the downside. And you really need to, as a practitioner, exercise due diligence if you're advising clients on conservation easement valuations and deductions. Because merely accepting, the client walks in the door with this, they already bought it, and they're insisting they claim this deduction, you really got to be careful. It's going to be very easy to get snapped into this, and then the client comes back later when the IRS goes after the thing and blows it up and says, well, you should have told me, right? You should have known immediately, and how in the world could you have missed this, etc. That's the big problem you risk as a practitioner, even if you're not involved in putting together programs like this. That's a huge issue. Next up, the duty of consistency is an issue that arises from time to time in tax cases. And in this case, we have an innocent spouse relief where the taxpayer obtained it, making certain, basically, she essentially told the IRS that certain things or implied certain things about her financial situation. And now when the IRS is trying to basically collect the taxes due from her ex-husband, remember, she was innocent spouse. She's removed from a $1 million assessment. Now she comes back and says, no. That thing you just seized, I own 1/2 of it. I get half the money. Yeah, the court didn't go along with this. This is United States of America versus John D. Stacy, although we're going to find out that John's not really the party mainly involved here. This is United States District Court for the Northern District of Texas. The decision came down on April the 2nd. Now, let's talk about tax liabilities and marriage. John Stacy incurred significant tax liabilities, and he married Emma Stanley in year 2000. He formed in 2004 Arts Investment LLC. It was formed by Mr. Stacy, and he acquired what becomes the Grand Prairie property, which is going to be the property in question here, the one where Emma is going to want half of the sales proceeds. We'll get there. Now, in 2007, they began divorce proceedings. So remember, they married in 2000. 2007, things weren't going so well. Got to imagine that this huge IRS assessment didn't help matters. And essentially, the divorce was finalized in 2011, with the court retaining jurisdiction over division of assets until 2024. In 2015, the IRS issued to Ms. Stanley, to Emma, over $1 million deficiency notice, right, in unpaid taxes and penalties related to 2000 to 2003. So now we're sitting there. So first part we have is this problem of Emma's got this $1 million assessment against her. So what Emma did, she sought and obtained from the IRS relief from the innocent spouse, both under Section 66 of the Internal Revenue Code. The Section 66 is that, community property. We have special rules on community property, divisions, etc. And 6015, which is the general innocent spouse provisions. Now, she signed, under penalties of perjury, a Form 8857. And on there, by implication, she indicated that she had no assets by leaving Part 4 asset disclosure entirely blank. They were asking you to list your assets. She listed none. Okay? Now, this is important because there are various ways one gets innocent spouse relief. And in many cases, or in some cases, especially for equitable relief, it's important to show that you would be financially damaged if you had to pay that. And so you tell the IRS, look, I don't have any of the assets, I don't have income, etc. Therefore, if you actually assess this $1 million against me, I'm going to be destitute, bankrupt, etc. It's horrible, terrible. I shouldn't be, this shouldn't happen. So the IRS did grant Ms. Stanley over $1 million of tax debt relief under innocent spouse provisions. They found her only responsible for $400 of the assessed tax. And that was based on her petition to the IRS and the Form 8857 she filled in under penalties of perjury, which had a blank list of assets. No assets were listed on that form. Now, we move forward. In 2023, the government moved forward and took action against Mr. Stacy, her ex-husband, to enforce the tax liens on him to collect that judgment, the amount that they had, or the deficiency. In 2023, there was an agreed judgment. They determined that Arts, remember Arts, the thing with the Grand Prairie property, was Mr. Stanley's alter ego, and that he owns all Arts assets, including the Grand Prairie property. In 2025, that property was sold for $750,000. Now, the proceeds were split. Half went with the court to deal with this, issues, right? Due to Ms. Stanley claiming that she had a right to half. Right? The other half went to pay down part of the tax liability. Now, she asserted a 50% ownership interest in Arts and sought a portion of the sales proceeds, saying, hey, wait, that was community property. I have a 50% right in that. Therefore, I should get half of those proceeds. Now we get into why the court doesn't really care too much about whether she did or didn't have that right. We'll get to that. This runs into the duty of consistency, a quasi-estoppel case, right? It prevents a taxpayer from taking an inconsistent positions, the detriment of the government, right, after the statute of limitations is run. The IRS can no longer revoke her innocent spouse relief. They can no longer go back and essentially change that feature. So what's happening right now is that she's saying, no, I have this asset. It's my asset. Now, quite obviously, if it's her asset now, it was her asset then. And it is very possible, had the IRS determined, had the IRS known she had $375,000 asset, she might not have gotten the innocent spouse relief. She might have gotten or at least reduced innocent spouse relief. So there is a problem. They said there are three elements of what's called the duty of consistency. There has to be a representation or report by the taxpayer, number one, on which the commissioner relied, and an attempt by the taxpayer after statute of limitation is run to change the previous representation to harm the IRS. In this case, the representation by, Emma was her blank 8857. It listed no assets. Didn't have this on there. Number two, did the IRS take action in reliance upon that? Yes. They granted her innocent spouse relief. Now is the taxpayer attempting, after statute of limitation is run, to change that representation, which would work to the harm of the government. And this is where the argument came in. Now she claims, I never told them I didn't have that asset. Leaving it blank, I didn't say anything. So really, I didn't tell them anything, right? The court didn't buy that theory. The court found that leaving the asset section blank constituted a representation that she had no assets, right? And the court said the why or the truthfulness of the representation is immaterial to the first rule. If she is going to later assert a right of ownership to some or all of that asset, she had to disclose that on the 8857. When she disclosed nothing there, even if that representation is wrong, right? Or even if she did it because she thought, her ex-husband would fight her on this, so she'd never really get access, she couldn't get access. None of that matters. She left it off. None of that was disclosed to the service. Therein, the IRS implied, right? The IRS has to consider the entire application as a spouse relief. That's required under their rules that they, under the law, they must consider it. Therefore, it is basically implied that they considered the fact that she had no assets. They don't have to prove that that was a key component of the grant of relief. they granted relief. Nobody challenged it, so it wasn't exactly like we went through a lot of details on the whys of her relief or had it subjected to a lot of scrutiny. And certainly her ex-spouse didn't, object on that basis, so he wasn't doing anything. So we didn't see that. So ultimately, she was stopped from claiming an interest in Arts or the Grand Prairie property due to the fact she claimed she had no assets. So for purposes of asserting a right against the IRS to any of this money, she was essentially out of luck, right? She couldn't use that. She couldn't change her story at this point in time when the old story, the new story no longer would harm her. That's basically the way it is. That also means it's important to have full and accurate disclosure on these documents and have a long discussion. You got to realize there are non-tax issues that come into play, such as ownership of this property. The fact that she made this representation to the IRS, and now it's in this court finding, could hurt her if she was trying to argue for any other rights to property, even if the service wasn't trying to grab it. She said she had no assets. Courts will tend to hold that admission against interest against the taxpayer, right? They made an admission in another case. He took a position in an unrelated case, which gave them a huge benefit, and now they're trying to change it. The courts often consider that too as a separate concept. So you got to be very careful there of understanding, yes, leaving that off, and yeah, the IRS didn't question it, so it seems like, hey, that was great. It worked wonderfully. And maybe they just don't question that. That's fine, but there can be non-tax ramifications from that, as we had in this case. Remember, those statements can have significant future implications, and that goes out into the future. Remember, this is key, those statements that were made to the IRS, because again, if you try to take a contrary position in the future after the statute's closed and say, ha, 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 you can't change that anymore, it's ha, 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 you can't change your position anymore. And it doesn't matter, your position is obviously right now. It's irrelevant because you asserted an opposite position, and you don't get the benefit of the fact that the IRS didn't go through and do a deep dive, analysis and, try to prove your position inside and out, or disprove it. That doesn't matter. You made that. You make that assertion. You got to live with it, right? Duty of consistency prevents taxpayers from benefiting from prior representations to the detriment of the government. It's an equitable position, right? Equities, remember, equities are sometimes apply in court, sometimes don't, but in this case, it applies. The idea is you can't get this unfair benefit from doing that. Finally, let's talk about the case of basically Strieby versus Commissioner, Tax Memorandum System 2025-28 on April the 3rd. Now, this involves the investment credits related to energy property, business energy property, and the passive activity rules that are in play, and why this little tax shelter didn't work the way that the taxpayers are. There's a lot wrong with this shelter, but the passive activity rules are what the court could just use to shut it down immediately. So let's talk about the facts of the case. Kelly and Jan Strieby, were essentially resided in Arizona, the taxpayers, married couple. They invested in Solar Farm LLC, and they claimed investment tax credits under Section 38 based on energy credits under Section 48 for 2015 and 2016. Now, interesting enough, their membership agreements in these the LLCs was signed after the close of both tax years. Okay, that puts a bad smell over everything before we get started. It's like, yeah, so you find out you owe tax, you go out and you buy this shelter after the fact. That's what it certainly looks like. Of course, they're going to claim they really were invested ahead of time, but, and the agreement that allocated these amounts to them, yeah, everything kind of happened perfectly afterwards, right? And what really happened here was there was a predetermined credits and circular flow of funds. The agreement specified credits amounts, anticipated refunds, and the subsequent contributions back to Solar Farm. So how much they owed for their initial contribution was tied directly to how much credit they got. So you can kind of see how this is, potentially a problem there as to how their refunds would come. So yeah, it's a little problem. And there's also a problem here that Solar Farm didn't file a 1065 for 2015. And the 2016 Schedule K1 was inconsistent with the tax return filed by the taxpayers. So, yeah, it's kind of a problem here, right? There was no partnership return filed for 2015, despite the fact they're claiming this solar credit from a partnership they claim they invested in. And then they turned around in 2016, and it did do a K1, but the K1 issued weren't the numbers they used. Okay, so to say this was sloppy is probably being very generous. This structure that was set up, but we have an issue, okay? Now, one real problem you've got is that when you have a talk about tax credits for a passive activity, you generally don't get them except to the extent you have income and tax arising from passive activities that could be offset by passive activity credits, right? So there's a problem here because we're going to find that, in fact, the taxpayers really didn't. They just put down money, right, and got a credit. It's not really going to be material participation, whatever you look at, right? They're not really materially participating in anything. So they really needed the passive activity rules not to apply. So they asserted that, in fact, it didn't apply to Section 48 credits because Section 48 is not in the subpart that's mentioned by Section 469. They cited Revenue Ruling 2010-16 for an analysis that they claim should apply to this as well. Now, we'll get to the problem with that revenue ruling here in a second, the court will, but they said that was it. So they said, yeah, Section 48 credits are not in the right subpart, therefore they're not subject to passive activity rules, therefore we get them. This sounds like a theory someone pieced together for them, right? This was kind of the basis of the shelter, was that you could get these credits, right? They also claim sufficient basis in solar farms to permit the credits to be claimed, which, again, is going to be kind of iffy because the problem is going to be, that we didn't determine how much they had to put in until after the year ended, and so they didn't put it until after the year ended. And, yeah, retroactive basis really isn't something that works. We're going to be looking at that. And they said they did not reflect negligence, so they shouldn't have an accelerated penalty if, in fact, they did understate their tax, if they owe tax. Tax court is not going to like much of any of this, right? First, 469. Let's look at the past activity rules. The tax court said, hey, guys, cute, but not good. Section 48 energy credits are allowable under Section 38, which is in Subpart D. Subpart D is referenced in 469. So that's a bit of a problem, making them potentially passive activity credits under 469 D2A little I, right? And they cite a number of prior tax court decisions pointing this out. So the Section 48 credits are covered. Okay, we're in trouble right now because they become Section 38 credits. It also said that, Revenue Ruling 2010-16, it related to a wholly different credit, right? The Section 45D New Markets credit. It's not applicable to Section 48. And they said it's clearly distinguishable. It's very specific, and you don't have a credit that gives you that exact same analysis for Section 48. The credit requires depreciation to be allowed. That is part of the energy credits, right? For business energy credits must be depreciable property, meaning that property must be used in a trade or business or help production of income, right? Section 167A and 174A and B. Solar farms purported activity is relevant. What did the partnership do? And that's partnership's business, which they need to totally participate in, right? Their only involvement was sign the documents and pay cash, right? Which does not constitute material participation under Section 469 H1 and the related regulations. Merely writing a check is not material participation. Therefore, all credits under 48 were disallowed to the taxpayer because they didn't materially participate, right? They're stuck there. So basically, those entire credits, which, by the way, had been set up exactly to offset, the tax they had that year. It was neat. They figured out how much tax they had that year, and then they would essentially buy up the credits as necessary and get allocated the credits and then pay up the sum, which, would generally have an amount to go in plus the fee for the promoter, right? Or, the guy in charge, the guy promoting this thing would get his fee too out of it. So we'd have that. Okay. On actually related penalties. Actually related penalties under 6662A were upheld for negligence. Negligence includes failure to make a reasonable attempt to comply with the code. And this invokes the court did the too good to be true doctrine. A fair to reasonably ascertain the correctness of a credit that appears too good to be true strongly indicates negligence. A reasonable person should have thought that just going out there after the end of the year, after you get your tax return numbers computed, and buying a credit to offset that tax, that sounds too good to be true. Right? You know, the supposed solar equipment that was in the business you were operating last year that, oh, by the way, you had no liability to pay for, really, until we got to this year. The fact it was a very suspicious arrangement should have raised the taxpayer's ire, or raised the taxpayer's concerns. The timing of the agreements, they all came after the end of the year. That just seems suspicious to a person even if they don't have a lot of tax training, right? The fact that the credit amounts were predetermined and the circular flow of funds, you know, the money came to the, you know, basically you put money in, that money comes back, offsets your tax, right? That whole circular flow of funds going round and round, that really should have, you know, raised somebody's concerns. And they said the reasonable cause and good faith exception didn't argue reliance on information return of a professional, an information return of professional advice. And they said, and even if they had, their inconsistency in reporting would have further undermined this good, reasonable cause and good faith exception. So theoretically, remember, we told you that the valuation, you couldn't claim reasonable cause. You can for the accuracy related penalties of 6662. For the most part, not the valuation one. But this one, yes, you could. But your problem is now that the way a taxpayer often shows that is either they relied on a professional advice of an independent party. They didn't claim that here. That was provided all relevant details, or that they relied in good faith on information return. And well, they said, well, that one's off. And whether or not it would have been good faith is a different question. But the mere fact that the first year you had no information return, and the second year, you know, you didn't report what was on the information return anyway. So you weren't relying on that. So sorry, reasonable cause, good faith doesn't work in this case. Now, the implications, you got to look for economic substance for tax advantage investments, right? You need to look at them skeptically, especially if the only advice the taxpayer has to date has come from the promoter. The promoter needs to sell the thing. Just understand that, right? They're looking at this is how they're going to make their money. Let's be honest. That's how this works. That doesn't mean they're wrong. It just means that we need a party who does not depend on you buying this, you know, to get paid for the transaction, to get paid for the work they're going to do on evaluating it, to evaluate it. Somebody who can give you a no, who does not have an economic incentive to only give you a yes. That's going to be there. You got to be very careful on interplay of code sections. My guess is that this could be a problem for some tax professionals. You get somebody saying, look, Section 48 is not in that subpart. And that's just plausible enough that if you don't really go through the details, you may accept it. But, you know, you need to understand the in essence, you have to understand that Section 48, you know, in essence, this one's going to run directly back over to the subparts of Section 38, the investment credit, which is in the right provision. That's where it is. Ultimately, too good to be true is really important. If something sounds too good to be true, especially to you as a tax professional that's been around this for a while, there's a really good chance it is. Now, maybe not, but if not, it should be no problem getting an independent third party who has experience in the area and who has no skin in the game. You know, they're going to get paid either way to bless it. That blessing would get you a reasonable cause exception in almost all cases. But it's got to be a truly independent party. There's where the problem comes. You can't take a referral from the guy who's promoting it. You got to kind of find somebody on your own to look at it, and you can't opinion shop. That's also a way people blow that one. You know, you just keep going around until you find somebody who finally says, yeah, it's good. Understand to do a full-blown material participation analysis. You know, for pass-through investments and things like this, you've got to figure out if it requires material participation, if it does, what's necessary, which is way more than writing a check. You need to maintain thorough documentation and independently verify investments. That last part is crucial. A lot of people, their brains just turn off the minute you say there's a tax benefit, right? That they love that, they love that gem, that thing they're after, right? Kind of like Lord of the Rings, the precious, right? Remember the precious? Yes, the ring. They're so fixated on that they lose track of everything. So same basic problem here. Your client is looking at the nice, shiny object. You need to point out to them that before we get that nice, shiny object, we have to clear this nasty stuff. And you need to evaluate it, because the fact there is a nice, shiny object there means that you're going to be held to a higher standard than if it wasn't there. That's going to be the issues. And it also suggests, negligence. You're going to get the 20% penalty. If not, now in this case, it mentioned the substantial understatement penalty, presumably didn't apply, which is kind of interesting, but still the way it goes. But that's it. We need basically negligence, and we need reasonable cause. Real backup is the best way to avoid the action-related penalties, which is advice from an independent third party who at least appears to have the background and knowledge to actually evaluate this, and who makes a thorough investigation after having been given all relevant facts. That's going to be the key. Well, this has been the current federal tax developments for April the 7th, 2025. Next week is probably more questionable about whether we'll get something out, because that'll be on the 14th, and I don't know if any of you care on the 14th anyway to listen to this, but still, it's there. Good luck with all your tax stuff coming up. My email address here, edzoller's.currentfortaxdevelopments.com. You can email me there with questions or issues. I also do follow the Connect sites for the Arizona, Illinois, New Jersey, Minnesota, societies of CPAs. You can and Idaho, get all the groups in there. Societies. So if you got some questions, you can post them there. Otherwise, we'll look forward to seeing you somewhere in the future. It may not be for next week. It may be 2 weeks. I'm just warning you ahead of time where things are going there. But we'll take a look. Good luck for the rest of your tax season. And we will see you back here in the future on current federal tax developments.